Hi everyone, welcome to Top Down with TCM. My name is Dylan Nguyen.
I'm John Kennedy.
And my name's Robert Ruiz. Today, we'll be talking about the risk in the market, how that translates to sectors that we like and dislike, and how we see risk unfolding within the consumer. Stocks keep going up, ultimately, and there has to be a certain point where the risk does take foot in the actual investment
Yeah,
that
because
people are investing in.
the risk that you're taking on isn't worth what you're paying for, especially compared to historical values. It's
For sure.
Yeah.
Highest it's ever been, pretty much.
Yeah. The spread you get is as low as it goes right now, basically.
Especially with dipping into fixed income a little bit. The spreads are 20-year tight.
Yeah.
So there's been a large amount of people being kind of, maybe we shouldn't go more risky. Maybe we should just focus more on their safe havens and companies that are producing cash flows, and these somewhat now overvalued companies that have a large tech presence, as many companies are within indexes and such.
Yeah.
Yeah. I want to circle back to what you kind of mentioned about bond spreads. And I actually got to talk with one of the managers over at Pacific Life regarding this. And I asked him, what do you think of credit spreads now that, long-term rates are going to remain higher for longer and you're starting to see that tightening? And he was like, yeah, we really do. We do like the high spreads. Obviously, that's good for returns as a whole. It's better than the summer because just, yields are higher in general. But, now the opportunities to profit are much less thanks to the tight spreads. So you have to be really cautious about that at the moment.
Yeah, especially just adding on to that, there is a point in which spreads will widen. Although they did stay pretty tight prior to the Great Financial Crisis, I want to say, there is a point where they are going to widen up.
It's just a question of when, not if.
Yeah.
But that's always kind of the thing. Yeah. Something that I was, a podcast I was listening to was talking about how a lot of credit managers are more trying to manage duration risk right now than credit risk, because they're just there's just not a lot, they feel like there's not a lot that they can do about the credit risk right now because everything's it's tight all across the board. And so they're just I don't really know what I can do. So they're just well, we'll do our best to manage what we can, which is duration, which I thought was really an interesting thought. Was just oh, yeah, you can't. I guess there's not a lot that we can do about that right now. Spreads are tight. The only thing you can do really is allocate more towards treasuries or something. But then
you're not really taking any other additional spread.
Yeah.
It kind of ties into, I don't know if you had time to read the article, but there was an article that was given to us where it stated a wide majority, the market earnings have been strong, and that's really what's driving the tight credit spreads. Companies keep making money. Companies keep earning their profits and even growing them. Consumers are still spending. It's like you mentioned, it's just a matter of time. When they stop, then those spreads will actually take foot.
Yeah, when the consumer starts to suffer a little bit.
Yeah. And I mean, as part of your analysis on the econ team, I saw you guys wrote a resilient consumer there as well. That seems to be kind of the general consensus at the moment as well.
But it does seem like they're resilient, but they're suffering a little bit, especially the lower end of the curve.
Yeah.
And I know something that you might have seen discussed was student loans haven't been considered haven't been reported as delinquent, but they started being reported as delinquent as of September 30th, and so we won't really see the effect of those reportings, that tightening on credit for consumers until just late end of this month, maybe start of the next year. And it's just especially because we all know of people going I'm just not going to pay my student loans. I'm gonna hope that it gets forgiven.
Yeah. No, definitely that'll be a pretty big thing coming up. I think, like you mentioned, a lot of people just they thought oh, I don't really need family student loans. They'll be forgiven down the line. You know, it's whatever. And now it's, I mean, we'll have to see. I think, and you know, I know some places are predicting delinquency rates to go up. That's,
Mhm.
you know, that's probably from that, and also maybe like from credit card debt and all these other sources as well.
Yeah, like credit card debt has the percentage of like 90-day plus delinquent credit card debt has reached almost similar levels to after the great financial crisis.
Yeah.
And
Yeah.
although it's kind of like overlooked by the market, with companies starting to track um, student loans delinquencies
Mhm.
again, that might have a bigger impact because it's more covered
Yeah.
by news sources because it's highly debated within politics.
Mhm.
And although credit cards and also auto loans have become even more delinquent,
Yeah.
it's not really covered that much.
Which is tough, but
Yeah.
kind of the way the cookie crumbles. I know. I don't know. I was gonna say something about Mark Meldrum, but now I'm blanking on what it was gonna be. Something that he had pointed out.
Was it in one of his like economic?
Yeah, it
Updates.
was from something about his econ, but I don't remember what it was now.
Gotcha. Yeah. Well, I think, you know, so basically what we're saying is, you know, right now consumer may remain resilient, but you know, down the line we see several things coming up that may change that perception, and definitely the market is pricing in a pretty optimistic scenario at the moment. It seems like everything continues to go up, spreads tightening, and it's like, oh, I mean, yeah, inflationary expectations are going up again, so it seems like we're not really expecting some slowdown, or at least it's not being reflected at the moment.
Mhm.
I would say.
I feel like they've been pricing that in for like a while too, since tech has really become more popular within the market.
Mhm.
People just are kind of afraid of missing out on the next big investment to get into, so they're just funneling all their money into
Oh yeah.
into the market.
I was
Yeah.
gonna ask because I kind of know Robert's general position on this from like the RFP. What kind of because I guess it's easy to point to like everything and be like, oh, it's kind of like all valued really high right now, but it's like, what do you think would be like an opportunistic sector if you had to do like the RFP? Because you have like I know RFP we said like energy and what was it? Healthcare. And we said like, oh, we don't really like tech and consumer discretionary.
Mhm.
But it was like what else is like on the table there, you think? Either of you guys, because you have like financials on the table. I know Edson says he likes financials.
Yeah.
And a lot of
Even
speculation.
after the rally as of late.
I mean, yeah, because
Kind of what you're asking is what hasn't been priced in by the market. What's been kind of slept on.
Yeah.
In a way.
I guess I wanted to know, like, because I kind of know Robert's opinion, but I wanted to know if you had any extra thoughts on that. But also, like, Robert, you have more to share.
Yeah, I think I don't have a specific sector in mind. I think it just goes back to, the general principle that the big stocks at the moment, the tech sector is trading at a pretty high valuation. And if I were to look for, investment opportunities, it'd probably be in the lower cap or some other opportunities that aren't widely traded or recognized or covered necessarily. Yeah, I don't have like a particular sector to give you in regards to that.
That's fair.
I feel like financials is going to be really popular within the short term, especially with
Election results.
not only election results but also Fed funds cuts
Yeah, yeah.
and people getting really excited about lower interest rates, lower short term interest rates.
Mhm.
So
That's
I
true.
feel like financial is definitely going to pop off in a way and become more actively traded, potentially on a similar level to tech. Whether it may replace tech or not, it could.
You think so?
Yeah, I definitely feel it has the potential to replace tech, especially since such high valuations have been given to existing tech companies, and although their earnings have resulted, their increased earnings have resulted in them being actually like
Priced
relative-
kind of appropriately as
Priced-
they go up
yeah,
sometimes.
exactly. But considering the concentration of, for example, indexes like the S&P 500, over 25% of the index is made up of the Mag 7. So there's definitely there's going to be a time where that changes and shifts start to move around.
So you're saying you think the returns for that might change? Because I don't think that capital like
Structure will change.
flow. Like I don't think the capital flow will necessarily change.
Mhm.
Because like, and I mean, it would take like decades to get there.
Yeah.
Because like, obviously, you have like what 6, 7, 8 trillion in the top like
Mhm.
couple companies.
Yeah.
Mhm.
I don't really. So is that what you meant? You like more
Yeah,
returns?
definitely returns because, like you had mentioned, it's going to take years
Mhm.
for companies to even catch up
Yeah.
to even $1 trillion.
Yeah.
Tesla hit $1 trillion once in the past,
Yeah. They're at
but
like
then it dropped down.
they're like 600-700 billion right now. I think.
I don't remember off the top of my head, but they did reach $1 trillion once, and it hasn't reached it since then. So definitely returns are going to be favored towards more other companies once an amount of shift happens. Definitely.
According to Google, they're at 1.2 trillion right now. Actually.
Oh, they're back there.
Are they?
They're back.
I think it's a lot of Elon just like pushing
Yeah.
it back.
Post
yeah.
election.
Yeah.
I'm not surprised by that.
Because they did soar after the election. Too.
They
It's been
did.
a month since then.
Yeah.
Kind of makes sense.
Oh yeah, I definitely agree though.
But I mean, just that they were at $1 trillion before. I forget when, 2022, 2021.
21.
Yeah.
I think 22 before the fall. Probably.
Yes.
Yeah.
Yeah. So 2 years, 2
Yeah,
3 years to get
in
back
that
to where they
range.
are. And some companies aren't even touching that.
Yeah. I think tech stocks, what you're seeing in a lot of their earnings, let's just say Nvidia, for example, is you're seeing a lot of the volatility post earnings. And even if earnings might be like pretty decent, right? Like I don't think if we looked at the past few earnings Nvidia had, they were necessarily bad. They didn't like significantly lose on any profits. In fact, they gained quite a bit. But expectations are just so high for a stock like that. It's like anything that they say that's not expected by the market or is slightly negative could see the 5% to 10% drops. But then I mean now it's, let me check what exactly it's at right now.
Yeah. The sentiment on it is just like crazy.
Yeah.
Basically, it's just like
It's still pretty elevated.
anything that changes is just like but it's like kind of at the precipice almost where it's like something like anything goes horribly wrong. You have like China invades Taiwan, say, or anything like that. It's just like
They're cooked.
That's it.
yeah,
That's it.
down like 50%.
Yeah.
Or something like insane.
Dot
all
com.
that. Yeah.
I want to come back to what you said, Dylan, about the expectations of earnings. I feel like that's really a big gripe that I have with the market, especially because of how much that happens, how frequent that happens.
Mhm.
So much high expectations come of companies.
Yeah.
And although they do meet earnings and they do meet those expectations, they didn't beat those expectations as they were intended to. I feel like it feels like there's two expectations the market has around earnings times. One, a more reasonable expectation that they might hit, they might not. If they hit it, that's definitely a good sign for the company. But then there's the expectations that the actual market wants it to hit.
Yeah.
And I feel like it's definitely something harder to quantify because it's not a set stone number that's able to be gathered through like analysts and their ideas.
Yeah.
It's something that the market as a whole has decided on what a company should be earning.
I guess that kind of goes back to what we learned or like what we read from the summer was the second level thinking, right?
Yeah.
Where it's like, they beat, but like
Did
how
they?
much? Yeah, exactly.
Did they actually beat?
Yeah. It always comes back to
Sometimes I don't even know if the market knows what it wants.
It doesn't.
I mean, can we talk about Workday? Like it went right after earnings, it went from 270, shot to 290, and then dropped all the way down to 240. Like it's just so like. And I thought, I mean, when I read through the earnings, I thought it was good personally, but
Yeah.
And then I saw like articles saying, oh, they underperformed. I'm like, but then they started listing metrics that like, oh, they beat EPS. I'm like,
Yeah.
I don't know
Well,
anymore.
they're actually good. They're fine.
Yeah.
I feel like it happens a lot with tech companies specifically because there's so much focus on them. Because there's such
That's true.
such a volatile sector, and a lot of market news has put so much focus on them, saying that's what drives the world. When they drive the digital world, but other companies do as well.
Mm-hmm.
So I feel like there's a big discrepancy in what the market is expecting and what the more internal market is expecting.
what the second level
Mhm.
is expecting,
Yeah.
more or less.
Yeah, I don't even think it's just a tech stock thing because you see it in other like companies as well or company earnings.
Yeah.
Just because again, market as a whole is pretty expensive at the moment. So, I mean, you're not just going to see that volatility from tech. You're going to see it just across the board in a lot of areas.
So do you think? I mean, how do you feel about it in like consumer discretionary? I guess because that was kind of the other one that we had for the RFP was like, oh, maybe we look to avoid this. Do you think that's like a valuation thing, or do you think it's just like or was that more based on like consumers
Yeah.
exclusively?
So I think on the first level, it was definitely a macro consumer view.
Yeah.
We had a feeling that consumers probably weren't going to spend as much. It's different because you get into retail specifically and like clothing retail. That's kind of different than actual
Whole discretionary,
yeah. Like automobiles and appliances.
Mhm.
People splurge on clothes.
Yeah.
That's pretty obvious, and they're gonna obviously dig into their credit for
Mhm.
that. So that's not really a surprise on how companies such as like Abercrombie and Fitch and Lululemon have still grown
Yeah.
as even though the consumer is a little bit stressed.
Yeah.
But you see companies such as Stellantis, like I did a report on,
struggling incredibly.
exactly.
Yeah.
So
Yeah.
there's definitely two sides to the consumer discretionary. Those being, yeah, maybe we could splurge on this. I need that, and then I could drive the car for another 2-3 years. That's okay.
Yeah.
Yeah, definitely. I mean, I think the automobile industry I think is just shook up by Chinese EVs as well, but that's another story. I think that consumer and I have a lot of things I want to talk about this actually. I did read some articles regarding the latest Black Friday sale, and it seems like it actually
Went pretty
grew year over year. So I think people are still spending, maybe just not in certain areas of discretionary like you mentioned.
Yeah.
But there's the consumer demand still there certainly. But yeah, I'd love to hear if you guys have anything to add to that.
I feel like I didn't hear a lot of news about Black Friday. I completely like overlooked.
I saw a few things about like how same thing you saw basically was that like they had kind of not beat expectations to say, but like they had beat last year at the very least in terms of growth.
Yeah.
I know like some of that likely we'll see the data in like next couple of months, but probably a decent amount that came from like consumer credit or things that wouldn't be considered consumer credit like buy now pay later.
Yeah.
And I think there's two kind of opposing views on consumer credit growing. It's like either someone is more confident in their ability to make the payments on their credit because they're more confident in their job, etc. Or there's the other half where it's like, well, I don't have any other way to make this payment, so I'm just gonna have to eat it and take it on credit. And I think it's really interesting because I feel like you have both ends of the spectrum that apply in different. Like I think they both kind of apply right now for different people.
Yeah. I feel like additionally the decreased inflation within just staples in general has allowed consumers to start spending a little bit more on like apparel and other discretionary items. So potentially when inflation was a little bit elevated, there was a little bit more focus towards staples.
Yep.
And that's where that growth came from within staples. But now there's a little bit more shift towards discretionary. But still, the overarching theme is consumers are still spending.
Yeah, definitely.
Whether it be directly from their bank accounts or
credit, buy now pay later,
which is a whole different issue.
Yeah, truly.
I think that whole thing of buy now pay later is gonna crumble at some point.
You think so?
The terms on it are just. I mean, people are using it, exploiting it for ridiculous things.
Yeah.
If you've seen so.
Yeah, there's definitely been a lot of research on my end into that, and I think there needs to be a lot more because people could just load everything on there.
Yeah. There's absolutely no like restrictions.
And it's basically just a credit card with extra steps that you pay fees on.
Yeah.
And it's like, if you miss the late payment, then you get obliterated.
Yeah, exactly.
Which is tough.
But they market it as you don't get obliterated, you'll be fine.
Yeah, exactly.
Now, on the other hand, though, when it comes to just consumer discretionary, there were two things that I noticed, which were Target and Walmart earnings as of a couple of weeks ago. I don't know if you guys have seen anything about that, but
We got asked about it during the RFP, actually.
Really?
Yeah, we did.
Okay.
What were you going to say there? Go ahead and finish.
Okay, interesting. So, well, basically, these two retailers, they compete with each other generally on basically their consumer base, but what we kind of saw was Target kind of stagnating and not really growing much in their sales versus Walmart, which saw like 20% e-commerce growth, 3% same-store sales growth. Like they really outperformed this past quarter, whereas Target kind of slumped and its stock reflected that. Its Target stock plummeted, and it already didn't really outperform the S&P, but now it's definitely not. And Walmart's still the darling that continues to go up and kind of take the consumer market share in that whole area.
Yeah, we got the I think our the question that we got about it like during the RFP was like, oh, like you guys like he was like it was Ben Lau. He was like, do you think the consumer is struggling right now, or do you think the consumer is going to struggle? Because Walmart just reported earnings and they beat expectations massively,
Yeah.
et cetera, et cetera. And so Robert took the first part of the answer, which
I'd explained to him on a counter argument to Walmart, Target took a loss on earnings, being a result of slower consumer spending. I didn't go too much into Target's earnings specifically, but I had read some articles about just Target taking a loss. And essentially you have to dial it back to Walmart exists as a inferior good retailer. Not saying products are bad, but Target also exists as a normal good retailer. When consumers have more discretionary income, they may shop at Target for more quality items. But when they may be struggling a little bit and struggling to make ends meet and living paycheck to paycheck, they may shift their spending to Walmart, where they could get more discount goods and just be comfortable in their spending there without having to actually go into Target, where they might have to pay a little bit premium for maybe additional quality.
No, exactly. Yeah. I think that Walmart specifically cited in their earnings call that they saw, I'm sure you guys have noticed this when we did our Dollar Tree research as well, the trade down effect, where the high income households are starting to actually shop more at Walmart. And that's what drove a lot of Walmart's growth actually, which is really interesting, whereas Target, stagnated.
That's why I kind of love retail, especially because so much goes into the actual stores or even the food establishments in their pricing strategies. Like you had mentioned, Target had cut prices in order to attract more customers that may be on a tighter budget. But Walmart and Target still have their loss leader strategy in that they're able to sell these consumer products like produce and packaged goods at a discount, taking a loss on them while they're able to make up that loss within their discretionary purchases like clothing, as we mentioned previously. So I feel like, given my experience researching Target, Walmart, Dollar Tree, Dollar General, and now Sprouts, I feel like it's definitely increased my understanding of the consumer specifically.
It's also really interesting, like how many different ways you can create a profitable consumer company. Because like you said, like you can price things really low, like Dollar Tree, or you can basically take loss leaders, or there's 1,000 other ways you can like create a differentiated model from somebody else. But at the same time, like when you model it, half the time it comes down to like the same stuff where it's like store count, AUV, et cetera, et cetera. So it's like it's almost formulaic in that sense, but discovering what makes them different is always unique.
And I feel like you kind of have to, tying it back to what we started talking about at the beginning of this, we kind of have to really understand what makes companies stand out in order to determine what company is best to invest in. Because a lot of retail companies and a lot of food companies, they're overvalued on a relative base to other companies. For example, Sprouts is trading at a 44 times PE. But they still have a long way to grow within their stores, as well as within their product offerings and ability to actually make their logistical systems more efficient. similar to Dutch Bros, as Hayden was also doing.
Yep.
Not only focusing on revenue generation from store openings, which they have focused on in the past, but actually increasing the comps of their existing stores. So kind of striving away from what the market expects of them already, causing them to become more overvalued and actually getting into a newer strategy that'll actually drive the long-term growth that even the market doesn't know about because they're considering the short-term goals.
Yeah, I think most analysts' projections only go to the like 2 years at the most,
2,
right?
3,
Yeah, like maximum 3. So if you consider like the 10-year horizon or something like that, you can get a lot of value out of that.
Yeah.
And it can help you adjust for the risk that we were talking about earlier with the equity risk premium. You can say like, oh, maybe the price isn't perfect right now, but like this is a company that I want to be in, and I don't want to let it get away from me. I think that's something that JVH talks about a lot too, which is like with Coinbase, and he says the same thing about Bitcoin, which personally I don't feel that way, but that's okay.
Yeah.
What are some other ones that he really likes that he feels that way about too? I'm trying to think. Oh, Eli Lilly is one of the other big ones.
Yeah. Pharmaceuticals in general.
Knife River, those usual ones.
Yeah.
But more specifically on the pharmaceuticals and Ozempic and stuff, that's specifically another example of what it relates to with tech and like retail in factoring in the long-term growth, but condensing it really short into short-term growth. So it really makes market realization happen really quickly.
Yeah.